Nicosia, Cyprus, Friday, March 15th, 2013. A property developer named Andreas closes his laptop at 6 p.m. and heads home for the weekend. He has 340,000 euros in his Bank of Cyprus account, the proceeds from a completed development project, parked temporarily while he negotiates the purchase of his next site. It's not his life savings. It's working capital. It's been sitting there for 11 weeks. He has no reason to move it. Cyprus has deposit insurance. The Bank of Cyprus is the largest, oldest financial institution on the island. The EU has just spent 3 years loudly promising that no depositor in a Eurozone bank will ever lose their savings. By Monday morning, the ATMs across Nicosia are showing a single message: temporarily out of service. By Tuesday, the government has imposed capital controls, the first in the Eurozone's history. No transfers abroad. Withdrawals capped at 300 euros per day. By the time those controls lift, Andreas will have lost 160,000 euros. Not to fraud, not to a bad investment, to a legal mechanism called a bail-in, agreed over that weekend in Brussels, that converted a portion of every uninsured deposit above 100,000 euros into worthless equity in a bank that was already insolvent. He didn't make a single financial mistake. What happened in Cyprus in March 2013 was not a bank failure. Banks fail, depositors get made whole by deposit insurance, creditors take a haircut, and the system moves on. That is the established procedure. That is what every guarantee, every regulatory framework, and every EU communique had led depositors to expect. What happened in Cyprus was something categorically different. A negotiated, legally sanctioned seizure of private deposits by a coalition of European governments and the IMF, executed over 72 hours, while the banks were closed and citizens had no ability to respond. And the part that almost never gets discussed, the part that makes Cyprus not a historical curiosity but an active blueprint, is what happened the week after. The EU quietly published a directive making the bail-in mechanism standard resolution procedure for every bank in Europe. This is an autopsy of how it worked, why it was possible, and what it established for the next time. The setup: a banking system built on a fiction. To understand March 2013, you have to understand what Cyprus's banking sector actually was. By 2012, the total assets held in Cypriot banks were approximately 8 times the country's GDP, according to the European Central Bank's Financial Stability Review from that year. This wasn't normal banking. Cyprus had spent a decade positioning itself as an offshore financial center. Low corporate tax rates, favorable treaties with Russia and the former Soviet states, light touch regulation, and English-language legal infrastructure. Russian oligarchs, Ukrainian business people, and Eastern European corporations had parked billions in Cypriot accounts. The banks took those deposits and invested heavily in Greek government bonds. When Greece restructured its debt in 2012, the largest sovereign default in history at the time, wiping out roughly 53.5% of private creditor holdings according to the IMF's post-program assessment. Cypriot banks absorbed losses that exceeded their entire capital base. The Bank of Cyprus and Laiki Bank were, by late 2012, insolvent. The question was not whether they would fail. The question was who would pay for the failure. The mechanism was simple. The answer was not what depositors expected. The weekend, 72 hours, that rewrote the rules. On the evening of Friday, March 15, 2013, Cypriot Finance Minister Michalis Saris boarded a plane to Brussels. What followed was 3 days of negotiation between the Cypriot government, the European Commission, the European Central Bank, and the IMF, the Troika, that had already restructured Greece, Ireland, and Portugal. The initial proposal, leaked on Saturday morning, was a flat levy on all deposits, including those below the €100,000 deposit insurance threshold. This was rejected, partly due to Cypriot parliamentary opposition, and partly due to the obvious signal it would send to depositors across the Eurozone. The final agreement, announced Sunday evening, March 24th, was more targeted. Laiki Bank would be wound down entirely. Deposits below €100,000 would be protected. Deposits above €100,000 at both Laiki and the Bank of Cyprus would be subject to a bail-in, converted at a forced rate into bank equity, with the percentage determined by the resolution authority. For Bank of Cyprus depositors above the threshold, the final conversion rate settled at approximately 47.5%, according to the Bank of Cyprus's published resolution terms. Nearly half of every large deposit converted overnight into shares in an insolvent institution. Nobody who held an account above €100,000 in the Bank of Cyprus on the morning of March 15th had any legal mechanism to object, appeal, or exit. The banks were closed. Capital controls were in place before they reopened. The conversion was executed as a regulatory action, not subject to the normal creditor protections that would apply in a standard insolvency. That figure, 47.5%, should terrify you. Not because Cyprus is large, because of what the EU did the following week. The template. What nobody reported. On June 26, 2013, approximately 3 months after the Cyprus bail-in, the European Parliament adopted the Bank Recovery and Resolution Directive, the BRRD. It came into force across EU member states in January 2015. The BRRD formally established the bail-in as the standard resolution tool for failing European banks. Under its framework, when a bank becomes insolvent, the resolution authority can convert or write down the claims of shareholders, junior creditors, senior creditors, and, if those are insufficient to cover losses, uninsured depositors. Deposit insurance still protects balances below €100,000. Everything above that threshold is explicitly in scope. The Cyprus bail-in wasn't an emergency improvisation. It was a field test. The EU watched it work, watched capital controls contain the panic, watched the legal mechanism hold up against challenges, watched the financial system absorb the shock, and then codified it as policy for 27 countries. This isn't a historical curiosity. This is the playbook. 18 EU member states now have resolution frameworks modeled directly on the BRRD. The United States has an analogous framework under the Dodd-Frank Act's Orderly Liquidation Authority, established in 2010, which gives the FDIC resolution powers that include the ability to impose losses on certain classes of creditors in a systemically important bank failure. The specifics differ. The architecture is the same. That's the historical record. Now here's why it matters today. The mechanism. Deposit insurance. Has a ceiling. The most dangerous assumption in personal finance is that deposit insurance is a guarantee of safety rather than a guarantee of a specific threshold. In the United States, FDIC insurance covers deposits up to $250,000 per depositor per institution. In the EU, the equivalent is €100,000. Below those thresholds, the protection is real and has held through every major banking crisis in the modern era. Above those thresholds, you are an unsecured creditor of the bank, legally equivalent to a bondholder, subject to the same resolution hierarchy. Most people with balances above those thresholds assume the insurance simply doesn't apply to the excess, that they'd lose nothing up to the limit, and the rest would be at risk only in an extreme scenario. The Cyprus case clarifies what that extreme scenario actually looks like. A 72-hour window during which the banks are closed, capital controls prevent any response, and the conversion is executed before you can act. The FDIC's Deposit Insurance Fund, as of its 2023 annual report, held approximately $116 billion against $9.8 trillion in insured deposits, a reserve ratio of roughly 1.1%. That fund covers insured deposits. Uninsured deposits, balances above $250,000, totaled approximately $7 trillion across the U.S. banking system as of late 2023, according to FDIC call report data. Those balances have no insurance. They have resolution procedures. The diagnostic, counterparty architecture. Again, the Cyprus case adds one specific layer to the counterparty question raised by every collapse this channel has examined. It's not enough to ask whether your institution is currently solvent. It's not enough to ask whether your government intends to honor its guarantees. The Cyprus case demonstrates that a solvent government can decide, in a weekend, that honoring its guarantees to large depositors is less important than closing a fiscal gap, and that the legal infrastructure to execute that decision already exists, was used once publicly, and was then formalized into law across an entire continent. Andreas, the property developer, had done his due diligence. The Bank of Cyprus had been operating for over a century. Cyprus was an EU member state. The deposit insurance framework was explicit. None of that mattered once the Troika decided that the alternative, a full bailout funded by European taxpayers, was politically unacceptable. The question isn't whether your bank is safe. It's whether your balance is above the threshold that makes you an unsecured creditor when the resolution authority runs out of options. Spreading balances across multiple institutions to stay below insurance thresholds isn't paranoia. It's the same calculation every informed treasury manager at every corporation makes as a matter of routine. The difference is that corporations hire people to think about counterparty architecture. Individuals are expected to trust the system and find out later. Andreas eventually received shares in the restructured Bank of Cyprus in exchange for his converted deposits. Those shares, when the bank relisted on the stock exchange, were worth approximately 10 cents on the euro against the original deposit value, according to Bank of Cyprus financial disclosures from 2014. He got back roughly 5% of what was taken, through a mechanism that was legal, precedented, and is now standard EU policy. He didn't make a financial mistake. He made an architectural one. He held a large balance in a single institution denominated in a currency managed by a supranational authority whose interests were not the same as his. The EU didn't steal from Andreas because it was malicious. It stole from him because he was accessible, his balance was large, and the mechanism had just been built. History already taught you this. Nobody showed you the receipt. If you want to keep reading the receipts, we perform economic autopsies here so you don't become the next case study.